Welcome to Smart Investing with Philippe. Today is the market update. Let's get straight into it. But before doing that, please subscribe to the channel, push the like button, and leave a comment to help me grow this community and to make this community more profitable and more successful with investment over the long term. We are going to watch a very important video from Tom Lee from Strat Capital. And stay with me until the end of the market update because this video will highlight everything I was talking about over the last 2 weeks. The 4 important reasons why the market could have a V-shaped rally and what is calling a face-ripping V-shaped rally. So stay with me, stay tuned, and let's go into it. Today, again, with the headline about the tariffs, uncertainty around tariff, and the looming deadline about the 2nd of April, and all the new tariff that Donald Trump might be imposing is again resurfacing on the headlines, and the market just corrected quite significantly today. I mean, yesterday we saw quite the last 2 days sharp increase on the market, and actually what is happening right now is that the market actually was rejected at the 200 moving average, at least for the Nasdaq. And I told you that was an important resistance level for the 200 moving average. But also what is quite interesting is that we have almost gap fill the gap up that we had 2 days ago. And that's good because usually these gaps are being filled. So the sooner the better. So the sooner these gaps are being filled, the better the market will rebound after that. So, but nothing to panic. You see, we are still very much higher than the lows that we've seen over the last 2 weeks, and you shouldn't start to panic again and say that the world is ending and the market will crash again and so on and so on. I know there is a lot of headlines on the news. I know there is a lot of YouTubers doing a lot of clickbait title and so on, but this is not the end of the world. It's just like the usual thing the market do when there is a sharp upside over 1 or 2 days, then the market always pull back a bit, and after that continue to rise again. But I'm not saying that's going to rise again and again, but usually this is what happened with this type of movement. On the SPY, same thing, rejected. Sorry, SPY, same thing, rejected at the 200 moving average, same as the QQQ, and almost doing the gap fill. So it might go tomorrow a bit lower to gap fill completely, and then after rebound from that. But again, nothing major again on today's trading session. We can see that most of the sales has been done on the large caps and the Max 7, and we can see that the VIX has increased also by 7% today, which showed that it rebounded, smacked onto the 200 moving average. So it's not abnormal that it's doing that. It's part of the process. The market will never go down straight and up straight, so it will always oscillate between a range, and after then keeping its trend down or its trend up. So I don't think that this is there is a lot of things to worry about this today trading market. When it comes to the Max 7, of course, is the biggest drop today, 3% down. But you see, it's just barely gap fill over the last 2 days. But what is interesting is that you see the upper channel of the last 2 weeks, the red bar here, and the red bar here, this is the channel trading over the last 2 weeks. It broke clearly outside this channel 2 days ago, and now it wants to retest that upper channel. You can see it didn't come back straight into the channel over the last 2 weeks. It just tried to test the upper limit of that channel and probably go back again on the upside. So I don't think that this is something unusual at all. Other than that, but then the market is doing its stuff. Big tech, some semiconductors, you see semiconductors just retreated quite sharply today. I mean, it's just completely gap fill and go back to the low of the last 2 days. So that's the biggest part of the downside of today. So if we look at now economic data today, Wednesday, nothing really major. Mortgage, Fed speak, nothing really interesting. But also what the market do is usually they pull back a bit to prepare for tomorrow's big day on economic data. We will have the continuous jobless claim, core PCE, GDP growth rate, and the initial jobless claim. So these are very important data. You have also some retail numbers and we take real consumer spending and so on. So I think that tomorrow is a big day for the market, and that's probably why the market has pulled back a bit today, just to prepare in case the numbers are not good at all tomorrow. Other than that, then if we look at the headlines, the headline one of the major financial news is the Nasdaq fall 2% as tariff angst rolls the market again. Yes, the negative headlines are, are coming back. So, the negative headlines and the market react. This is the way it is. Huh? Trump announced auto tariff today. White House say Trump rate imposing Cooper import tariff in weeks, not months. So you see, it's all about tariff. Nothing new under the horizon. And you shouldn't panic because we've been through that. So let's see now, maybe Reuters, to see what has been the headline on Reuters. It ends down sharply on tariff worries, Nvidia, Tesla drop. You see, again, the headline on Reuters is the same as Bloomberg, all about tariff, all about uncertainty on tariffs. Nothing really new, just the usual stuff, just we have to go through this tariff uncertainty until that it's become or the market get used to this uncertainty, or the market just move on from this uncertainty. Okay, now I want to go through a video that I've watched today about Tom Lee. Its latest update on the market and its in the portfolio that he's currently managing. But I think there are a lot of few things that he's talking about that I want you to hear. And maybe that will complete the very short market update that we had today, because nothing new, it's all about tariff. But what is important is that he is reinforcing exactly the same message as I was giving you, that there is not much left to the downside, and we're going to see a V-shaped recovery. You just need that the uncertainty of the market just vanish, because all the indicators for a rebound is there to happen.
I'm the Chief Investment Officer of Fundstrat Capital and the Portfolio Manager for Fundstrat's U.S. Large Cap Granny Shots ETF. This is our update for the week of March 23rd. I want to cover a few particulars. The price as of March 21st was $18.65. The NAV. To zoom out, because the market's been through a rough, turbulent period recently. And as you can see, the S&P at 5770 is roughly at the same level it was 8 months ago. In fact, the market actually has been arguably trading in a pretty wide range over the past 8 months. Now that might raise some questions for you, such as, well, with this recent correction, does that mean stocks can stage a strong rebound, or is there even fuel left for stocks to have upside? So let me just sort of point a few things out for you. If you look at money market cash balance.
Okay, before we continue with Tom Lee's video, I want to show you something that technically is very perfect, is that you can see we have, like he said, we have range bound over the past 8 months, and the market is exactly at the same level as the past 8 months, so it's almost close to a year. The market has not moved at all. It went up dramatically, but down to the level of 8 months ago. But what is interesting is that the market bottomed exactly at the same level of the very strong support level of 5,700. And that's exactly at the level of the top of the double top that we had last year, It's not a coincidence. It's usually the case, the market technically stopped at the level of the last peak, or the last two peaks of the last bull run. And usually if it go much lower, then it will be that it will go to the level of 5,200. But usually that will stop here, because that's exactly the support level that we've seen in the past, because the resistance level is becoming the support level, and usually we rebound from there. So that's something that I wanted to highlight to you before we continue.
For you. If you look at money market cash balances at the end of July of last year was 6.1 trillion, and they're currently 7 trillion. So even though the S&P's been roughly at the same level, money market cash has risen by roughly $850 billion. That's a lot of dry powder on the sidelines, ready to buy stocks. If you look at margin debt, even though the S&P is at roughly the same level, margin debt has been declining recently, and we don't have the number for the end of March just yet. It's published monthly, but my guess is that it's come down a lot. So I don't think margin debt has risen significantly. Again, that means there's some dry powder there. And if you look at fundamental long-short positioning by hedge funds, this is data provided by a prime broker, you can see that the net long positioning is the lowest. It's much lower than it was a year ago, and really it's the lowest since before 2020. All of that to me looks like it's fuel for upside, especially for a market that's been stuck in a range. And I think it is fuel for a face ripper rally. Now, the pretext to this, and it's been something I mentioned last week, is that the stock market had a waterfall decline, the fifth fastest 10% decline ever since 1950 at least, and that those other 6 precedent declines of 10% in a similar time period were actually shocks to the market. They weren't the start of a major downturn. So when you think about stocks from their 52-week highs falling this fast, this qualifies as a shock. Now, the drivers for this shock are, of course, the tariff war, the risk that Doge will create a recession, and that's evident in the anxiety of consumers. This notion that there's no Trump put and no Fed put. So these are the reasons why markets lost faith over the past month or so. Now, last week we got a reminder that there was actually a Fed put with the FOMC rate decision. And as with regard to the tariff war, as you can tell recently, the rhetoric has been dialed back, and it looks like there will be some deals coming into place, but it won't be as drastic as many expected. In fact, it looks like Trump wants to make a deal. As for a Doge recession, that remains to be seen, but given how we've dialed back rhetoric around a tariff war, I wouldn't be surprised if there's going to be dialed back rhetoric around the severity of cuts around Doge. And then lastly, I think, and it's something we addressed last week, that there is a Trump put, and it's been evident by what's happening with Tesla stock. In fact, in our view, Tesla is exhibit A for a face ripper. If Tesla can stage a V-shaped recovery, I think that that's a template for what the S&P can do. Now, for a little context, Tesla has fallen 50% from 488 in December to a low of around 220. And the reason for that is that Elon Musk has become quite controversial because of his role at Doge, so much so that some analysts are calling for Elon Musk to take a step back from Doge. Now, that's not something that the White House wants, because if Elon Musk leaves Doge and goes back to Tesla, that might be good for Tesla, but that would stall, I think, a lot of the efforts for Doge and the government finding cost savings. And so as a response, the White House obviously wants Elon Musk to stay, and part of that has to come with actually making sure Tesla stock actually stops falling. So that is the Trump put at play. In fact, I think that's why we're starting to see what looks like to be a V-shaped bounce in Tesla. Our technician, Mark Newton at Fundstrat, believes 330 is the key level to watch. That would confirm a V-shaped recovery is underway, and that would allow or set the stage for Tesla to make all-time highs again. So from a Tesla perspective, which is owned by the Granny Shots ETF, it makes sense to actually stand firm here, expecting Tesla to bounce strongly.
Okay, so I didn't want to go through the whole video of Tom Lee because he's updating about these specific funds, but I don't want to, we're not really interested about all this fund data and what is invested in and all these things, What I was more interested in is what do you think about a V-shaped recovery from this point now on the market, and why he actually gave his 4 indicators that we've discussed over the past few market updates. Over the last 2 weeks, you have the Trump put, the Fed put, the Doge recession, and the tariff uncertainty. So he has actually described why he doesn't believe that these 4 will stand, and why the V-shaped recovery will be happening in the next few days or few weeks. He gave an example of Tesla, and Tesla will be the canary in the mine. If Tesla rally, the rest of the market will rally. So that's it for today. If you like the video and the market update, please subscribe, like the video, and make a comment. Have a good evening.